U.S. government shutdown entering its second week. And of course, that's meant the absence of key economic data that investors rely on. Let's get more on the effects of this shutdown on the U.S. economy. We're joined by Jeffrey Lacker, former president of the Federal Reserve Bank of Richmond, Virginia, and now a senior affiliated scholar with the Mercatus Center at George Mason University. Jeffrey, thanks very much as ever for joining us. Start off with the actual economic effect of the shutdown. Say, for example, hundreds of thousands of workers or even millions are furloughed in America. What is the actual effect on GDP if this thing drags on?
Well, the evidence from past shutdowns is that it's fairly minor. Those are large numbers of people affected, but people tend to smooth, the workers affected tend to smooth through the loss of income for a time. Most furloughed workers are going to get their pay back when the shutdown ends. And so the numbers aren't large enough unless it goes on for 3 or 4 months. And no one anticipates that. But yeah, it's going to be minor. It's not going to push the economy into a recession.
I know we can't get into this in detail, but when people are laid off, if and when they're laid off because of the shutdown, the lost wages, do they get them restored to them when activity starts again?
Yes, we've been through these shutdowns so many times that Congress passed a law about what happens in a shutdown. And one of the things that they provided for is that furloughed workers get their back pay when the government reopens. So, and in addition, you've got essential workers that are working without pay. They get their back pay as well. As the shutdown goes on, there's a tendency for some workers who are essential but aren't getting paid to call in sick at greater frequency and some other things that can kind of be disruptive. This shows up most notably with the TSA workers at airports. You have lines getting long, things like that. But that tends to not happen until a few weeks in.
I mean, this is harder to measure, but you reckon it's not a good look if you're trying to convey the image of a stable place to invest, for example.
No, it doesn't speak well to the U.S. government's state capacity, I guess academics call it. Just our ability to govern ourselves in an effective way without incurring unnecessary inefficiencies and costs. So it is a bad look. It's symptomatic, though, of just a general evolution of governance in the U.S. That's made it difficult for us to come to decisions and actually do stuff.
What about the lack of information, the labor force information, the non-farm payrolls, et cetera? Investors, presumably, if this drags on, will have to look for other sources of economic indicators.
Yeah, it's true. So the FOMC, the Federal Reserve, meets on October 29th, so they won't have the employment report for September. That was supposed to come out last Friday and didn't. And they'll be missing also a big CPI report, which would be released on the 15th. But, having said that, first of all, there's an old saying in central banking, never make a decision based on 1 month's data. So even if the data they're missing would have been big surprises, they would unlikely to have made a decision about it. It would be 2 or 3 months data that would make them sort of alter course. But then on the other hand, they have a lot of other sources of information. The reserve banks around the U.S. have a lot of contacts, business contacts. There's a lot of state and local data that's still coming in. For example, unemployment claims is probably the most sensitive indicator of labor market conditions. That's collected by the states. It's funneled up to a Department of Labor website in Washington and published sort of automatically without needing the intervention of paid Department of Labor employees. So that data is coming out and continuing to come out. And that would give a timely read. Plus, there's private sector substitutes. There was a release this morning by Carlyle Group that estimates that 17,000 net workers were added last month. So there's a lot of other sources that can piece together to find out just what's going on in the economy.
This is an interesting argument by you. You say it's not clear whether interest rates are high enough in the United States to count as restrictive, aka slowing the economy. You think that they're fairly neutral right now?
Yeah, I think a strong case could be made for that. There's a couple of ways to go about thinking about it. Neutral is the rate at which you're not adding more stimulus than the economy needs, or taking out or restricting unnecessarily or inappropriately economic growth. And there's sort of statistical models that tease that out. And if you go down that path, you get an estimate that's about 4%. And the error bands around that estimate are wide, about 1.5%. The estimate of neutral, think of it as essentially 3.5 to 4.5, or a little bit wider than that. Well, that suggests that they're in the neutral range. The other way to think about whether policy is restrictive or neutral is to look at its effects. So the narrative over the last year and a half is that inflation came down rapidly at the beginning of 2024. The Fed began cutting in September of last year, before inflation had gotten back to their 2% target. I think the idea they had in mind was a rendezvous where they'd get the funds rate down at the end of the year to where it should be if inflation was 2% at the end of the year. But they started cutting in September, and instead inflation plateaued at around 3%, and it hasn't come down much since. The current push to cut interest rates is based on the sense that there's downside risks to employment growth. But the labor market is pretty well in balance right now. Keep in mind that, so the headline employment growth numbers are much lower now than they were last year, the year before. But a year or two ago, we were getting 2 to 3 million net immigrants in the U.S., and that was increasing the labor supply by a really very substantial amount. And demand, luckily, was growing fairly rapidly as well. Now, net immigration is virtually zero. Labor supply has slowed to a crawl. Labor demand is dampened as well. It's not growing rapidly, as a lot of firms are waiting to see how the dust settles on tariff policy. And so we've got demand and supply roughly in balance, but growing very slowly. The good evidence of that is that unemployment claims haven't gone up. The unemployment rate's about the same as it was a year ago. But there's this habit of thought people have about employment growth. The idea is that if employment growth's low, downside risks are increased. Well, that can't be independent of labor supply. I mean, if the market's in balance, it's not clear downside risks have gone up. So they're cutting rates based on assessment of risk, even though if you looked at current data, the fact that inflation is above target and the labor market now is in balance would suggest that you hold pat. So it's a difficult situation they're in.
Jeffrey, thank you very much. We could talk to you all day, but I hope you come back soon. Thank you very much.
Great. Thank you.
Jeffrey Lacker, former president of the Federal Reserve Bank of Richmond, Virginia, now a senior affiliated scholar at the Mercatus Center at George Mason University.